Asia credit market has grown by about 5 times over the last 10 years, and the high yield part of that market's grown by about 10x. But it's still only the same size as the US was in the mid-90s. And that decade was really a golden period of investing for high yield and distressed credit in the US. That's really when some of the larger managers such as Oaktree, Elliott became what they are today. So we see that same opportunity set in Asia over the next decade. That's part of the reason why we're really excited to be launching this Australian unit trust that's focused on that part of the market, is because we really see this market's going to continue to grow pretty rapidly over the next decade, but it's still quite inefficient. So, you see a lot of mispricings and flow-driven moves where, someone in London or New York will make a decision to allocate less capital to Asia credit, and that'll set in motion some large selling by, say, long-only funds in the space. And we can take advantage of those mispricings and opportunities. It's also very under-researched. So if you compare what's written in terms of literature on the sell side for equities versus credit, it pales in comparison. There's much more written on single-name stock research versus what you see in companies for Asia credit. So in that respect, it's growing rapidly, but still quite inefficient. And so that allows a lot of, I guess you can have an opportunity for informational edge and analytical edge that we try to take advantage of. So if you look at the yield on the index for Asia high yield, it's about 12% at the moment. And that's close to the all-time highest levels. You really only see these levels in times of global crises. So European financial crisis, 1 or 2 weeks during March 2020 during the COVID period, global financial crisis. So we think that initial backdrop is quite interesting. And if you look at it relative to what you see in the US and Europe, the differential in yields is also the highest of all time. So we think both on an absolute basis and a relative basis, it's quite interesting. So that's part of the reason why we're pretty bullish on the market over the next year or two. Often people think that, but we do a lot of work on the fundamentals of the businesses. And so what we're looking for, number one, is an improving credit profile. So improving fundamentals, which could mean a cyclical rebound in an industry. It could mean improvement in the competitive position of a business within that industry. And number two, we're looking for high quality corporate governance. So we only invest in companies that we know the management and shareholders. We're very comfortable with the corporate governance, which I think is paramount in investing in this region. And so I think it sort of goes back to what I was mentioning before, where what we've seen is a lot of the flows have gone into the US and Europe over the past couple of years coming out of COVID. And that's because European Central Bank and Federal Reserve announced they were going to start buying individual corporate bonds. And you didn't have that dynamic in Asia. So, the allocation decisions have been, at a global level, have been moving money into US and Europe and outside of Asia. So I think if you look at that yield on the index, that doesn't necessarily have to do with the fundamentals of the individual businesses within that. It can just be, outflows from the space that's caused that to, the bonds to sell off and then the yields to go up. Obviously, the biggest impact for this in the markets we look at has been the rising commodity prices. And you've seen oil prices, base metals, so nickel and copper, shoot up pretty dramatically. The way we've been looking to take advantage of that is we've had exposure to the natural resources space, both metals and mining and energy. And that's been a key call within Tribeca, over the last year or so. So those companies obviously will benefit with the rising commodity prices. So their fundamentals are actually doing better. But of course, the sentiment in markets broadly is going to get hit by Ukraine and Russia. And that's led to a sell-off across markets, whether it's credit or equity. So we actually like that opportunity because we see the business fundamentals getting better for these companies, but the prices of the bonds have actually fallen. So that often is a pretty interesting opportunity for us to start buying. So the fund gives access to a part of the market that I don't think most Australian investors have looked at necessarily or have access to. It's kind of the opportunity on the doorstep for Australia that most people aren't looking at. So we invest in the Asia corporate credit market. We also invest in Australia, which has been about 20 to 25% of the fund. But more broadly, it's within Asia. So Southeast Asia, North Asia, India, et cetera. And the yields on offer there are much higher than what you see in Australia. So I mentioned the index yield is about 12% at the moment. You compare that to other yield options in Australia, whether it's government bonds at 2%, bank hybrids 3-4%, equity dividend payers 4 to 5%. So we're much higher yielding, and have actually been able to outperform those other asset classes inception to date, going back to July 2019.